In the world of real estate investment, financing options can make or break deals. One popular financing option is the DSCR, Debt Service Coverage Ratio, loan. This type of loan is widely used by investors looking to acquire or refinance income-generating properties. It allows borrowers to secure funding based on the cash flow generated by the property rather than relying on their personal income. In this video, we'll dive deep into what a DSCR loan is, how to apply for it, who is eligible, what it can be used for, and the pros and cons of this financing option. What is a DSCR loan? The DSCR loan is a type of real estate loan primarily used by investors to finance income-generating properties like apartment buildings, office spaces, retail centers, and multifamily homes. The key metric that lenders evaluate when granting a DSCR loan is the debt service coverage ratio, which measures a property's cash flow against the debt service, loan payments. It is calculated by dividing the property's net operating income, NOI, by its total debt service, principal and interest payments on the loan. For example, if a property generates $120,000 in annual NOI and its annual debt service is $100,000, the DSCR is 1.2. A DSCR above 1.0 means the property generates enough income to cover the loan payments, while a DSCR below 1.0 suggests insufficient income to cover the debt. How to apply for a DSCR loan? Applying for a DSCR loan requires careful planning and documentation. Below is a step-by-step guide on how to apply for one. 1. Determine your DSCR. Before applying, you should calculate the DSCR of your target property. Most lenders require a DSCR of 1.25 or higher. Make sure to have an accurate estimate of the property's NOI and the potential loan amount. 2. Prepare financial documents. While DSCR loans focus on the property's cash flow, lenders will still require basic financial information. You'll need to provide documentation of the property's income and expenses, rent rolls, leases, utility bills, etc., as well as your credit history and personal financial statement. Some lenders may ask for tax returns, but your personal income will be less of a deciding factor compared to traditional loans. 3. Choose a lender. Not all lenders offer DSCR loans, so you'll need to find those who specialize in real estate investment loans. Consider working with mortgage brokers who have access to various loan programs. 4. Loan application. Fill out the loan application with all necessary details, including the property's address, type of property, and the estimated loan amount. Include any required financial documentation. 5. Underwriting and appraisal. Once the application is submitted, the lender will perform an underwriting process, which includes reviewing the property's cash flow and conducting an appraisal to determine its value. 6. Loan approval and closing. If the lender approves your loan, you'll proceed to closing, where you'll sign the final paperwork and officially secure the financing. Who is eligible for a DSCR loan? Eligibility for a DSCR loan is primarily based on the property's income, not the borrower's personal finances. However, there are still several factors that lenders consider when determining eligibility. 1. Property type. DSCR loans are available for income-generating properties. This includes multifamily homes, apartment buildings, office buildings, and commercial properties. Some lenders may also finance short-term rental properties like vacation homes or Airbnbs, but this depends on the lender's criteria. 2. DSCR ratio. Most lenders require a minimum DSCR of 1.25, meaning the property must generate 25% more income than the total loan payments. Some lenders may accept a lower ratio, while others require a higher ratio, depending on the risk. 3. Credit score. Although the DSCR loan relies primarily on the property's income, lenders will still review your credit score. A credit score of 620 or higher is generally required, but some lenders may require a score of 680 or more for optimal terms. 4. Down payment. Typically, DSCR loans require a down payment of 20 to 25% of the property's value. A higher down payment may be needed if the property has a lower DSCR or if your credit score is less than ideal. 5. Experience. Some lenders prefer working with experienced real estate investors. If this is your first time applying for a DSCR loan, be prepared to provide more documentation and possibly pay a higher interest rate. What can DSCR loans be used for? DSCR loans are versatile and can be used for a variety of real estate investment purposes. 1. Purchasing income-generating properties. The most common use of a DSCR loan is to purchase rental properties, whether residential, multifamily, or commercial. 2. Refinancing existing loans. Investors can use a DSCR loan to refinance existing mortgages on income-generating properties. This allows them to access more favorable loan terms or extract equity for other investments. 3. Property improvements. Some investors use DSCR loans to make significant upgrades or renovations to a property, increasing its potential to generate more income. 4. Portfolio expansion. DSCR loans are often used by investors who want to grow their property portfolios by acquiring multiple rental units. Pros of DSCR loans. 1. Focus on property cash flow. Unlike traditional loans that rely heavily on personal income, DSCR loans focus on the income generated by the property. This allows investors with limited personal income to secure financing for investment properties. 2. Flexibility in loan terms. DSCR loans typically offer flexible loan terms, including the ability to refinance or extract equity. 3. No income verification. Since lenders base the loan primarily on the property's income, borrowers may not need to provide extensive personal income documentation, making the loan application process faster and easier. 4. High loan amounts. For qualified properties, DSCR loans can offer larger loan amounts than traditional loans, helping investors acquire more valuable properties. Cons of DSCR loans. 1. Higher interest rates. Because DSCR loans are considered riskier for lenders, since they rely on property income, they often come with higher interest rates than conventional loans. 2. Large down payment. Borrowers may be required to put down 20 to 25% of the property's value, which can be a significant upfront cost. 3. Strict DSCR requirements. A property with a DSCR below 1/25 may struggle to qualify for a loan or receive less favorable terms. 4. Limited availability. Not all lenders offer DSCR loans, so investors may have to shop around to find a lender that fits their needs. Conclusion: DSCR loans are a valuable tool for real estate investors looking to finance income-generating properties. By focusing on the property's cash flow rather than the borrower's personal income, DSCR loans provide a unique advantage for those with strong investments but limited personal earnings. However, higher interest rates and large down payments can make this loan more expensive than traditional financing options. If you're an experienced investor with a profitable property, a DSCR loan may be the perfect financing option to expand your real estate portfolio. Thanks for watching. Please subscribe.